Most people think investing is complicated. It's not. It's just unfamiliar. This is your complete visual guide to accounts, brokers, and making your very first trade, the 2026 edition. Let's build your wealth machine step by step. The Wealth Engine. Why time is your greatest asset. Before we talk about what to buy or where to invest, we need to talk about the single most powerful force in investing, time. Here's the concept. You put in $1,000. Add $100 every month. The market gives you an average return of 7% per year, and then you do nothing. You just wait. At year 5, the growth is modest. At year 10, it picks up. But look what happens between year 20 and year 30. The coins don't just grow, they explode. This is compound interest. Your earnings start earning their own earnings. The longer the runway, the more powerful the engine. The best time to start was yesterday. The second best time is right now. Choose your financial vessel. Phase 1. Before you buy a single share, you need a container to put your investments in. Think of it like choosing between 2 types of jars. On the left, a taxable brokerage account. It's completely open. You can put in any amount of money and withdraw it anytime you want. The trade-off? When you make profits, you pay capital gains tax. On the right, a retirement account, or IRA. This one is locked until retirement age, and there are strict annual limits on how much you can put in. But in exchange, the government gives you significant tax advantages. Your choice comes down to one question. When do you need this money? If it's for the future, use the IRA. If it's flexible money, use the brokerage. The Account Architecture Matrix 2026 rules. Let's get specific. Here are the 3 main account types and how they compare under 2026 rules. A taxable brokerage has no annual limit. Invest as much as you want, but there's no tax break. A traditional IRA lets you contribute up to $7,500 per year. You get a tax deduction up front, meaning you reduce your taxable income today. But you'll pay taxes when you withdraw in retirement. And if you pull money out before age 59 and a half, there's a 10% penalty. A Roth IRA also has a $7,500 annual limit. Here, the tax break comes at the back end. Your withdrawals in retirement are completely tax-free. The early withdrawal penalty applies only on earnings, not your original contributions. One more difference. Traditional IRAs require you to start withdrawing at age 73. Roth IRAs have no such requirement. Your money can keep compounding as long as you live. For most beginners, the Roth IRA is the smarter long-term choice. The 4 pillars of a modern broke. Phase 2. You've chosen your account type. Now you need a broker to open it with. A great broker in 2026 stands on 4 pillars. Pillar 1, 0 commissions. In 2026, you should never pay a fee to buy or sell a standard stock or ETF. If a broker charges you, walk away. Pillar 2, fractional shares. This lets you buy a piece of an expensive stock for as little as $1 or $5. You don't need thousands to get started. Pillar 3, education and research. The best brokers have built-in simulators, real market data, and guides that actually explain things in plain language. Pillar 4, usability. A clean, modern interface that doesn't overwhelm you with charts and numbers you don't need yet. These 4 pillars together make a broker worth your trust. The beginner broker matchmaker. Not every broker is right for every person. So here's a matchmaker. If you're a knowledge seeker, someone who wants to learn deeply, Fidelity is your best match. Best overall for beginners with 24/7 live support. If you're a researcher, someone who loves diving into reports and data, Charles Schwab is your home. Unmatched market reports from the original discount broker. If you're a mobile-first trader, someone who wants a sleek app experience, Robinhood wins on design and seamless fractional shares. If you're an all-in-one optimizer, someone who wants banking, loans, and investing under one roof, SoFi brings it all together. And if you're a hands-off saver, someone who just wants to set it and forget it, Vanguard is the pioneer of low-cost index funds and automated retirement investing. Find your type. Find your broker. Spotlight, the titans of Wall Street. Let's take a closer look at the 2 heavyweights, Fidelity Investments, 5 stars. Their fractional share program, called Stocks by the Slice, starts at just $1. Their standout strength is customer service and a massive library of no-transaction fee mutual funds. Charles Schwab, also 5 stars. Their fractional program, Schwab Stock Slices, starts at $5. Where Schwab shines is in premium desktop tools, integrated banking, and access to detailed Morningstar research reports. Both are excellent choices. Fidelity edges ahead for pure beginners. Schwab rewards those who want to go deeper. Spotlight, the app-first innovators. Now for the app-first generation. Robinhood, the disruptor. 0 fees on options, a beautifully clean interface, and $1 fractional shares, built for immediate accessibility. It's the broker that brought investing to the masses. Webull, the active interface. Extended trading hours from 4 in the morning to 8 at night. Advanced charting tools, and built-in paper trading simulators, so you can practice with fake money before risking the real thing. SoFi Active Investing, the financial hub. It combines your checking account, savings, loans, and investments all in one login. And uniquely, it gives you access to certified financial planners for personalized. Choose the one that fits how you want to live. What are you actually buying? Phase 3. Your account is open, your broker is chosen. Now, what do you actually buy? There are 2 fundamental building blocks. First, individual stocks. When you buy a stock, you own a direct slice of one company. The upside? If that company explodes in value, so does your investment. The downside? If it collapses, so does your money. Second, exchange-traded funds, or ETFs. An ETF is a basket. One purchase gives you exposure to hundreds of companies at once, instant diversification, lower volatility. And because they passively track indexes like the S&P 500, the fees are tiny. For a beginner, the answer is almost always, start with ETFs. Let the basket do the heavy lifting. The anatomy of a trade. Phase 4. Let's talk about how a trade actually works. When you look up a stock, you'll see 2 prices, not one. The bid, the highest price a buyer is currently willing to pay. The ask, the lowest price a seller is currently willing to accept. The gap between them is called the spread. For highly traded assets like Apple or S&P 500 ETFs, the spread is tiny, nearly invisible. For rare or thinly traded assets, the spread can be wide, and that's a hidden cost. Here's the rule to remember. You buy at the ask and you sell at the bid. Memorize that. It will serve you for life. Executing the trade. Speed versus control. Now, how do you actually place the trade? You have 2 main options. A market order prioritizes speed. You say, buy this now. The trade executes immediately at whatever the current price is. The risk? In a fast-moving or after-hours market, the price you get might be slightly different from what you expected. Best used for highly liquid ETFs during normal market hours. A limit order prioritizes price. You say, buy this, but only if the price reaches X. Your entry price is locked in. The trade may not happen immediately, or at all, if the market never reaches your target. Best used when you want control, especially for individual stocks, speed or control. Know which one you need before you click buy. The safety nets. Ding downside risk. Every investor needs safety nets. Here's how to protect yourself on the way down. A stop-loss order is your first line of defense. If a stock drops to a price you set, it automatically triggers a market order to sell. It protects you from a free fall. But in a very fast crash, the execution price isn't guaranteed. A stop limit order gives you more control. If the stock drops to your trigger price, it places a limit order instead of a market order. The upside, strict price control. The downside, if the stock blows past your limit in a crash, the order might not execute at all, leaving you holding a position you wanted to exit. Think of stop loss as the safety net. Stop limit as the glass floor, strong but it can shatter under pressure. Use them wisely. The secret weapon, dollar cost averaging, DCA. Here is the most underrated strategy in beginner investing, dollar cost averaging. The idea is simple. Instead of trying to time the perfect moment to invest, which nobody can consistently do, you invest a fixed amount on a fixed schedule. Every month, no matter what. When prices are high, your $100 buys fewer shares. When prices are low, your $100 buys more shares. Over time, this mathematically lowers your average cost per share. And more importantly, it removes emotion from the equation entirely. No panic selling, no greedy timing, just a system that runs on autopilot. DCA doesn't just build wealth, it builds discipline. The 7-day launchpad. Now let's put it all together. Here is your 7-day launchpad, a concrete action plan. Step 1, choose your account. Taxable Brokerage or IRA, based on your timeline and goals. Step 2, open your brokerage. Gather your ID, social security number, and apply online. It takes about 15 minutes. Step 3, fund your account. Link your bank account and transfer your starting capital via ACH transfer. Step 4, pick your first asset. Start with a broadly diversified core ETF, something that tracks the total market or the S&P 500. Step 5, place your order. Use a limit order to control your entry price. Step 6, automate. Set up a recurring monthly deposit to trigger your dollar cost averaging engine automatically. 6 steps, 7 days. That's all it takes to go from zero to investor. The automated wealth machine, closing. And here is the master blueprint, your complete automated wealth machine. Your paycheck flows into your brokerage or IRA. A limit order controls your entry price. That money buys a diversified ETF. And the DCA gear keeps the whole engine running, month after month, automatically. Successful beginner investing is not about picking the perfect stock. It's about building a system and then trusting it. Right account, low-cost broker, broad ETF, limit orders, automated DCA. That is the formula for long-term wealth. Your machine is built. It's time to turn it on.